Hello, Bitcoin Basics listeners. Thank you for joining us. So what we have here is a series that I did for a local radio station in New Zealand called Fix the Money, Fix the World. Some of you might recognize that phrase. And what I've done is just gone through basic highlights of what's happening in the economy and how it actually affects the everyday person. So we've just uploaded those to the Bitcoin Basics podcast. Thank you, Gordon, for doing that. And yeah, I hope you enjoy. Thank you.
The following podcast is a live recording of a radio show first broadcast by FreshFM with assistance from New Zealand On Air.
Hello, everybody, and welcome to Fix the Money, Fix the World. I am Faris Mali, coming to you Monday mornings on FreshFM. So this is actually episode 1 of our series. The point of this series is we're going to talk about economics. And before you drive your car off the road or go into a metamorphic state, essentially we're going to try and make the study of economics, well, not so much just a study, but what is going on in everyday lives economically that is affecting us normal people out and about in our daily lives. How do big decisions by central banks, governments, all this data, statistics that we're hearing, how does it actually affect you as you fill up your car, go to the petrol station, or buy yourself a brew at the end of the day? So first of all, we need to state that economics is not a science, it's an art. With a mathematical equation, you can either be proven wrong or right. There's a binary outcome, yes or no. With a chemical experiment, it'll blow up or it won't, depending on what your predetermined outcome was going to be. You were wrong or right in that one. But with economics, it is not a science. We look at the history and how is that going to affect the future, and economists, central bankers, and governments try to plan accordingly. So it is not an exact science because the history of economics is actually based on human behavior. How will you, the consumer, behave? So there's 2 forms of economics. One is macroeconomics. So macroeconomics is what we're looking at is big picture stuff. So that's GDP of a country, interest rates. These are essentially decisions that are made by governments and central banks. So you yourself, as a business owner or a homeowner, do not set interest rates. That's not a decision that you're involved with. That's macroeconomics. These are big decisions by governments and central bankers. Microeconomics, these are consumer habits, or these are decisions that are affected and made by households and business owners. So, for example, how much money you're going to spend this week, where your money's going to go. Is it going to go to utilities? Is it going to be discretionary? These spending habits, that's microeconomics. So that's the main difference, is macro and micro. Now, who am I and why am I doing this? So my name is Faris Mali. I have previously taught international political economics. That's another form of economics. So political economics looks at how economies between different countries affects their behavior and their relationships. So, for example, we look at New Zealand, who are our largest trading partners, being, China, for example. And how do we trade with China? What do we trade with China? How does that actually affect our security relationships? That's what I studied, and that's what I taught in Melbourne University. I have also, in my history, been a derivative trader. That means I traded shares, currencies. I've even been into Bitcoin. I run a separate podcast called the Bitcoin Basics podcast. Now, this actually brings up a very important message in that what I'm doing today is purely educational. Please do not take this as any form of financial advice. I have been a local to New Zealand for 8 years now. From my accent, you'll tell that I was born and raised overseas. Majority of my time was actually in North Africa. Having spent the first 16 years of my life spread across 3 continents and 5 countries, educated under 3 languages, it was a natural progression for me to get into international relations. And from then on, as I grew and got into businesses as well, I found an affinity for money and economics and just how cultures and how we as people deal with financial decisions, and mostly how governments these days are dealing with them. In 2008, with the global financial crisis, I went deep down the rabbit hole of what caused the financial crisis. And that really strengthened my interest in economics. And that's when I started launching into this and into the role of Bitcoin in economics and finance a lot more. So what are we going to talk about today? So what's in the news lately is inflation. So how do we describe inflation in one sentence? One more thing I do want to mention is what I want to do here, guys, is I want to make this very, very simple for you to understand. So when I taught at universities, I taught 18 and 19-year-olds. And when you're talking about international politics, it can be quite boring. So my buzz was getting them to get excited and understand it. So I want to take the big, complex stuff that we talk about and bring it down to a level where it's easy for anyone and everyone to understand. All right, so what is inflation? In one sentence, it is the decline of purchasing power over time. All right, what does that mean? So purchasing power is the bang for your buck. So you would have heard the saying that 10 years ago, what you could buy for $1, you can't get today. 100 years ago, it was very different. So purchasing power basically means how much you can buy for the cash in your hand. And that dilutes over time. So that's worth less and less. So inflation basically is saying, here's how much of your currency is losing value against goods and services you wish to purchase. So we would have seen, for example, today, groceries have gone up. I was in a supermarket and I saw that cherry tomatoes are $40 a kilo. That's up about eightfold in just a few weeks. So what's caused that? So what happens with a lower purchasing power is it basically stops economic growth. So I was in a supermarket and I'm thinking, all right, I am not going to have a Greek salad with cherry tomatoes because, actually, I don't think you have cherry tomatoes and Greek salad, but hey, correcting myself before you foodies get on to me, because I'm thinking, all right, I'm not going to buy that. So I'm not going to buy those tomatoes because they're way too expensive. So that's curbed my spending habits. And if we're all doing that, how is it going to affect the farmer and the business supplying those? They're not going to get as much income coming in. And if they do so, they'll have to increase their prices even more. So what happens then is if our spending habits, what we choose to use our money to pay for, actually then has a trickle-on effect that goes on and affect the businesses we normally buy from, and they will have to make amendments themselves. So the power actually comes from the individual purchaser here. All right, we are going to talk next about what causes inflation. But before we do, I just need to give my voice a break. And we are going to hear from Kanye West and Adam Levine in I Heard Them Say. That was I Heard Them Say. And ironically, there was a message in there about minimum wage and inflation, which I was unaware of until now. All right, what causes inflation, everyone? So we have one criteria, which is called demand pull inflation. Demand pull. Now, this is usually a sign of economic prosperity. This is when things are going very well and people have more money chasing fewer goods. And this is when consumer sentiment is high. So economies are very much like the human spirit. You're either doing really well and really happy, or you're feeling down in the doldrums. So when economies are doing really well, you'll see people speculating and investing. It goes from a healthy economy to we're now kind of turbocharging, and things are getting a bit unhealthy. So a good sign of this was actually a couple years ago where people could invest in Hermes bags. So Hermes is a very high-end fashion designer bags. And these bags, from memory, were like $50,000 to $300,000 for a handbag. So what you could do is, if you can afford one, you and a few other people could buy shares in someone else's bag. This was obviously a sign that, okay, things are going a bit skewy here. A lot of financial advisors, hedge fund managers, economic philosophers will point to the fact that when we are about to build the world's next tallest building, that usually points to a sign that the good times are coming to an end. This was the case with the Burj Khalifa Tower in Dubai. That actually signaled the financial crisis when it happened. So this tends to happen when things are doing really, really well and everyone's really happy. We had the roaring 90s in America and around the world. That tends to be a sign of fervor. Things have just gotten a little too exuberant. So when that happens, when people have a lot more money chasing fewer goods, you're willing to pay more. We see a boom in real estate. We actually recently as well saw a lot of people buying old watches. So the way people see it is that my cash is not worth as much as these investments. So I want to buy these investments because they're going to appreciate in value. That's demand pull inflation, when more money is chasing fewer goods. The other one we have is called cost push inflation. So this is a sign that things are not so well in an economy, or something has happened, a big event has happened to trigger prices. And this is a narrative we're seeing right now with the supply chain issues that we've had coming out of the government lockdowns, and one argument being precipitated by the war between Russia and Ukraine is that something has happened where the cost of production has had to go up, which means the prices that you pay have to go up. So the example I gave of the tomatoes earlier, something's actually happened where if we look at the price of oil, that's gone up significantly in the last 2 years. About a year and a half ago, oil actually went negative for a day, which sounds insane, but that was because people were over-leveraged and over-trading it. But if the price of oil goes up, then there's a lot involved with oil. It's not just you fill it in, put it in your car at the tank. Cost of shipping has to go up. Manufacturing, because oil is in everything. It's in your plastics, it's in hair gels, it's in everything that oil is in. So the cost of everything goes up if oil goes up. So that is, oil going up is a very inflationary cost push inflation indicator. So there's another one called built-in inflation. So what built-in inflation is that if you are an employee and you are seeing that, as we are seeing today, the money that you are taking home is worth less, even though your paycheck has not changed. Say you're bringing in $500 a week. After tax, you're bringing in $500 a week. But petrol has gone up, groceries have gone up. So you are using more. So as we mentioned earlier, that means your purchasing power is going down. So because inflation is going up around the world, what you are bringing home is worth less. So at the end of the day, you have less. So what you do is you demand of your employer that they meet a cost of living adjustment. So that is in essence that they then start paying you what it's called adjusted for CPI. So CPI is a consumer price index, and I'll actually talk about this later. But if inflation is going up 3 to 4% a year, your cost of living is going up 3 to 4% a year, then naturally your wages should meet that. That is built-in inflation, where your pay packet meets that. This is all obviously theoretical. It can be practiced, but very, very difficult to do because inflation can skyrocket up and can come down just as fast. It's very, very hard to gauge the future of what inflation is going to do. A lot of people say inflation is like toothpaste. Once it's out of the tube, you're trying to get the toothpaste back into the tube. To give you an example, since the year 1990, New Zealand wages have gone up 177%. So since 1990, wages in New Zealand, the average wage has gone up 177%. Now that sounds like a lot, but inflation in that period has actually gone up 2,500%. So I'll say that again. New Zealand wages since 1990 have increased 177%, but inflation in that period is up 2,500%. So built-in inflation under that scenario clearly did not work or wasn't attempted. All right, so I'll go over those again. We have demand pull inflation. That's where more money is chasing fewer products. And this is something that we've seen since 2011, when the 2008 financial crisis happened. Markets started rebounding a couple years later. 2008, the central banks across the world, basically what they did was print more money, because their response was, if we put money into the system, people will borrow cheaply and they'll make the economy moving again. That actually didn't work because people were unemployed, losing their homes. The last thing they were going to do was get a cheap credit card, get a cheap personal loan, buy another car. The people who had money and had assets just bought more. And this is something we've actually seen in the last 18 months, is we've seen billionaires increase their wealth doublefold, I think. And then the middle income has actually been severely affected. So what happened with this is people who owned assets, so those assets go up in value and were able to buy more. People who didn't have assets got priced out of the market. So demand inflation is more money chasing fewer assets. Cost push inflation is now what we're seeing. So after we've had this period of exuberance of demand pull inflation, we now have cost push inflation, which basically the cost of living is going up due to seismic shocks or externalities, what they say, when you do something, something else happens. So that's what we're seeing now. Built-in inflation is what we might have expected, where they say, okay, we want a cost of living increase to meet current inflation. But that's very, very hard to gauge because we don't know how far inflation is going to go and we don't know when it's going to come back. All right, we're going to play another song right now. We are going to play Morning Light by Will Dorado, and then we will be back. That was Morning Light by Will Dorado. If you are just tuning in, this is Faris Mali on Fix a Money, Fix a World, Monday mornings on FreshFM, and then repodcasted around the world. So today we have actually been talking about inflation. We just went through what the definitions of inflation are, the different categories, and right now we're actually going to talk about how do you measure inflation. So there's various ways that central banks, governments measure inflation. How do we know we are in an inflationary environment? Most of you will know simply because the commodities that you are buying are more expensive than usual, or the services that you're ordering are more expensive than usual. So most of you know, governments like to send out figures. One of the main one they use is called the CPI. That's the Consumer Price Index. So what happens is on a regular basis, you will have a government employee who will actually go to a grocery shop around the countries and they will buy the same items. I think it's every year or maybe even every quarter. So they'll go through a checklist and they'll buy the exact same brand of tomato sauce, the exact same weight, and then they compare the price to the next year. So they go through this basket of goods and they compare, has the price gone up or has the price gone down? And this is one way that they measure inflation. So central banks, they actually do have an inflation target. It is different per country. Some countries run a higher inflation rate, like China, for example, is much higher than Japan. Most countries, as a rule of thumb, they're going for a 3 to 4% inflation rate target. So why is that? So first of all, if you are investing in property, you actually want that property to go up in value because one is it's providing you with money that you can then use as a consumer, but it's also tax revenue for some countries, so capital gains tax. So everyone making a little bit of money is beneficial for everyone is the theory. So that's what you want. If inflation is not going up, if you're buying a property and it's not going anywhere, you have outgoings, obviously. You need to pay the loan, you need to pay maintenance fees. You're not going to be a healthy consumer if that property is not making money. Because when you're making money, you feel good and you'll go out and spend some more. If you're not making money, you're going to knuckle down. So central banks can actually do two things. They can increase interest rates or they can print more or less money. So the response to the 2008 financial crisis was essentially to bring interest rates down and print more money. They did both. This was something that Japan did in the 1990s. Japan went through a period of amazing exuberance where real estate and the stock market went up and then they crashed and they had what was called the lost decade, where essentially they went through a 10-year period of just sluggishness. What actually helped Japan was the fact that the rest of the world was not going through this. So it was just centralized to Japan. That decade then became 2 decades. Unfortunately, the policies that Japan did, and to give you an idea of how bad it got, was in Japan, property got so expensive that they had to introduce generational loans, which meant that it wasn't a 30-year loan, not a 50-year loan, but a 90-year loan that they introduced. So you wouldn't pay it off, but your grandkids hopefully would. That's how expensive property got, that they had to introduce these loans just so people could afford the repayments. That is runaway inflation. So that's where the assets are getting far too expensive for everyday people to afford. That then crashed. All bubbles eventually do burst. That then crashed. And to this day, the Nikkei, which is the indices in Japan has actually not even recovered to the highs back then. It's still well below it. So unfortunately, the response in 2008 by the central banks of China, the European Union, America, basically followed the same suit that Japan did. They drove interest rates down and printed more money. For the anticipation was that they did not want the economy to stop moving. They wanted to avoid a 1930s recession. One of the problems with the 1930s is people just didn't borrow money. They just sat on, and it just stopped the system from moving. So Ben Bernanke at the time basically said that's what we want to avoid. So he wanted to make credit available cheaper. So the problem that actually caused the financial crisis was exuberance, too much money in the system, people buying assets. It was a huge property bubble. So what they did was they made it even more cheaper. So in essence, if you have a $5,000 credit card, you max that out, the bank's response will not be, oh, we're going to give you a $10,000 credit card and you repay the other one. So instead of being $5,000 in debt, you're now $10,000 in debt. No bank would do that to an individual because the bank's responsible. Unfortunately, this was the response of central banks. They decided, no, we're just going to go into more debt because we don't want you to stop what you're doing, which is spending money. So that's what they did. And what we've now seen is what some people have labeled the everything bubble, because we have seen a huge increase in equities, which is the share markets. We've seen a huge increase. Bitcoin actually went up in the same thing. We've seen an increase in property markets. The property market even went beyond the 2008 bubble. So everything's gone up in value. At one stage, the Prince of Saudi Arabia spent $450 million on one piece of art by Leonardo da Vinci. We've just seen so much money going out, and you sign into Instagram these days and you can see how many hundreds of millions of dollars one actor is worth. So we've just had this explosion in basically cheap credit that has then been converted into assets. Now, at the beginning of the 2020 government lockdowns, the money supply in New Zealand, so that's cash in circulation. So this is what we call M1 money supply. There's different types of money. This is the simplest one to measure. That's cash in circulation in New Zealand. Went from 8 billion, so 8 billion in cash of circulation in New Zealand, to 14 billion. That was a 50% increase in less than 2 years. And that's the largest nominal increase ever. So we almost doubled the money supply in less than 2 years. It went up 50%. Now, when we look at the economics of supply and demand, if there are more properties for sale than buyers willing to buy them, the price of property comes down. Property being the supply, buyers being the demand. If you go to an auction, you are the only person bidding, you're not going to bid. You're just going to negotiate for a cheaper price. Why? Because the property, the supply, there's just one. However, if you go to an auction and there's 50 bidders, that property is going to go for a lot more. So the more supply of something you have, the less valuable it becomes. And this is what we've seen is as governments have printed more and more money. Remember, when a government prints money, that is actually your money, the taxpayer, and future taxpayers that have to pay that back. Then it means that the value of that money goes down. So this is one of the reasons we're starting to see cost push inflation, and demand inflation is because they've printed so much money that people are using that money to buy other goods. So as more and more money has flooded the system since 2008 and since early 2020, what we've seen is people don't value their currency. It's essentially what we looked at earlier, which is demand push inflation. I don't want to hold on to my cash because that's going to be worth less in the future. I'm going to turn around and spend it. And that's what they've done to the point where we've had booms in real estate and all these other things I mentioned before. And now we're potentially seeing that bubble start to pop. So equity markets are starting to roll over. Commodities, which is oil, your grains, are starting to go back up. So we are starting to see inflation now. And when inflation is going up, that is then affecting what you pay for at the petrol pump and in your markets. So again, as I mentioned very early on, this is all theory and not science. But with governments creating more money, that money is worth less. And people who have access to it are not going to sit on it. They're going to invest it, because that's what's going to appreciate over time is a fixed asset. one of the things that we do see over time that goes up in value as inflation goes up is gold. And we are potentially looking at gold rebounding now. It did very, very well a few years ago. It has slowed down now, but it looks like it might be breaking out again. Again, not financial advice, just commentary. So the more governments print money, the less that money is worth. People that actually have access to excess funds, extra money, will go on and invest it, thus pushing the value of those investments up. But unfortunately, all good things must come to an end. And at some stage, we may see these things come down. And if they do come down, if the price of oil does come down, then inflation will subside as well. But this is all theoretical. This is all commentary. This is not advice, and this is not a science. All right, I hope that was enough for you guys. Now, if you have any queries, concerns, and if you want to see some slides relating to this, please go to my website, farismali.com. That's FarisMali.com.
Podcast you just listened to was a live recording of a radio show, first broadcast on Fresh FM with support from New Zealand On Air. Fresh FM is a community access media station based in Te Tauihu, the top of the South Island, New Zealand. The funding of Access Media makes these podcasts possible. To find similar programs by other community access media stations, go online to accessmedia.nz. If you or your group would like to know more about how you can have a program on our station, please contact us. Visit our website freshfm.net for our contact details.